Capital budgeting is essentially the art of committing today's funds for tomorrow's returns. I really want you to let that quote sink in for a second. We're not just talking about balancing a monthly checkbook here or, covering next week's payroll. We are talking about laying down massive, foundational financial bets right now, today, with the calculated expectation that they're going to pay off years or maybe even decades down the line. It's incredibly high stakes, it's absolutely irreversible, and honestly, it is the very heartbeat of corporate strategy.
Welcome to this explainer on the high-stakes game of capital budgeting. I am just so incredibly excited to walk you through this strategic playbook today. We're going to break down exactly how massive companies make these heavy, foundational financial decisions. We'll strip away all that dense jargon and look directly at the mechanics of how the biggest choices in business are actually made. Okay, so here's our roadmap for today. First, we'll examine the weight of tomorrow. Second, we'll walk through the decision gauntlet. Third, we'll look at measuring the potential payoff. And finally, simplicity versus financial realism.
Let's dive right into Section 1, the weight of tomorrow, betting on the future.
So capital budgeting really boils down to four main traits. First up, it involves long-term planning. You're looking way over the horizon. Second, and this one is absolutely crucial, the decisions are irreversible. Once you commit the funds, you're locked in. I mean, you can't exactly unpour a concrete foundation or unbuy a fleet of ships, right? Third, it requires a laser-sharp strategic focus. And fourth, it carries a very heavy financial weight. So why does all this matter? Well, because a mistake here doesn't just, dent a quarterly earnings report. A misstep here can literally sink an entire company.
Moving on to Section 2, the decision gauntlet, surviving the corporate bureaucracy.
Getting a project greenlit is a rigorous, unforgiving journey. It starts with identifying proposals. Someone in the company has a massive idea, but obviously an idea just isn't enough on its own. Next comes screening, where the completely unworkable ideas are just quickly tossed out. Then comes the real heavy lifting, evaluating. This is where the serious math and deep financial modeling actually happen. After that is prioritizing, because look, a company can't do everything. They have to rank the surviving projects against each other. And finally, approving, where the ultimate green light is given by leadership. It is a true financial gauntlet, specifically designed to kill off weak ideas before they can cost the company any real money.
Now, when those proposals actually make it through the gauntlet, they're going to fall into one of three absolute scenarios. First, we have independent decisions. These are accept-reject choices that stand entirely on their own. Basically, if it's a good project, you do it, and doing it doesn't stop you from doing something else. Simple enough, right? But then, there are mutually exclusive choices. This is a selection where one project literally cancels out the other. Imagine you own one single empty plot of land. Do you build a factory or do you build a retail space? You can only pick one. Choosing one mutually excludes the other. And finally, the harshest reality of all, capital rationing. This is where limited funds force you to rank by profitability. You might have 10 incredible, highly profitable ideas, but only enough cash in the bank for 3 of them. You are forced to ration your capital and rank them to find the absolute best bang for your buck.
All right, let's jump into Section 3, measuring the potential payoff, choosing your weapon.
I want you to step into the shoes of a CEO holding the corporate purse strings right now as we look at the grand battle of capital budgeting methods. On one side, we have the traditional methods, payback and the accounting rate of return. On the other side, we're bringing in the heavy artillery, the time-adjusted techniques. These include NPV, IRR, and the profitability index. There's a really profound narrative conflict here in finance. It's essentially the alluring illusion of simple, easy-to-calculate traditional methods squaring off against the rigorous, highly demanding math of time-adjusted techniques.
Let's look a bit closer at why those traditional methods, while definitely tempting, can actually be incredibly deceptive. Take payback, for instance. It's super simple, but it completely ignores the time value of money. It just tells you how fast you get your initial investment back. It's easy to grasp, for sure, but it completely ignores what happens after that payback period. And more importantly, it ignores the foundational fact that $1 received today is simply worth more than $1 received 10 years from now. Then there's the accounting rate of return. Now, this method uses profits, which sounds great, right? But its fatal flaw is that it completely misses cash flows. Profits on an accounting ledger do not always mean actual cash in the bank. And when you're committing today's funds, cash flow is reality. So I really want you to take this away. Ignoring the critical time value of money and actual cash flows are hidden dangers you simply cannot afford in high-stakes strategy.
So what's the antidote to those hidden dangers? Enter net present value, widely known as NPV. This is the supreme, reliable tool. The definition here is vital. NPV is a time-adjusted technique utilizing discounting.
And by discounting, it means it mathematically adjusts future cash flows back to what they're actually worth today. NPV is the absolute most reliable method when projects differ in scale or timing. Think about it. If you're comparing a $10 million project that pays out in 2 years against a $50 million project that pays out over 20 years, NPV levels the playing field so you can make a perfectly accurate apples-to-apples comparison.
And the thing is, NPV isn't alone in this fight. Let's explore the full time-adjusted arsenal. We have NPV, which, as we just established, is highly reliable for different scales and timing. Then there is IRR, the internal rate of return. Much like NPV, IRR brings in that crucial discounting factor, but it expresses the result as a percentage yield, which honestly, a lot of executives just love. And finally, the profitability index. This brilliant tool takes the NPV logic and refines it specifically to help rank projects. Remember that capital rationing scenario we talked about earlier where you have limited funds? Well, the profitability index is the exact tool you'd use to meticulously prioritize competing projects when money is tight. It builds directly on NPV's rigorous realism.
Which brings us to Section 4, Simplicity versus Financial Realism, the final verdict. Ultimately, each method balances simplicity against realism, and the choice depends heavily on the context. There is no single, magical, perfect weapon that's going to work for every single situation. I mean, if you're a manager needing a quick back-of-the-napkin gauge of risk for a minor equipment purchase, hey, maybe you rely on the simplicity of the payback method. But if you're the CEO committing billions of dollars to an irreversible long-term strategic pivot, you absolutely must rely on the harsh realism of NPV. It is all about balancing your approach based on the specific context of the decision you're facing.
Which brings us to our final thought for today. I want to challenge you to take this strategic playbook and apply it to yourself. If your own personal life savings were locked into an irreversible long-term bet, would you rely on the comforting simplicity of payback, or would you demand the rigorous, unforgiving realism of NPV? Think about how you allocate your own capital for tomorrow's returns. Thank you so much for joining me on this explainer. Keep questioning the numbers, and I'll catch you next time.